Do you want to be bought or backed? Founders need to be careful that they don't just take advice from the first person they meet who's aligned with one outcome, or just look at what their neighbors did who had one set of objectives. What's my timeline? Do I want to work here till I'm 85? Am I looking to retire next year? Do I need more money? Is my team going to stick with me? Do I need to give them liquidity on their options? They need to understand the diversity that's out there and how they align with those interests. Understand who you're talking to and align your incentives with somebody who can give you real advice.
Hey everyone, and thanks for tuning in to another episode of DIB Innovators. Today I'm speaking with Anita Antenucci, founder and managing partner of Three Wire Partners, independent investment merchant bank exclusively focused on the defense industrial base, something we love here at the DIB Innovators. Three Wire just launched a formal advisory board this past December and is quickly becoming a leading platform in aerospace, defense, and government practice M&A. She's got a great background, has been involved in some significant transactions over the past 3 decades, so I'm excited to dig into this. And Anita, thanks for joining me today.
Dave, it's really nice to meet you, and I'm now an avid listener of DIB's podcast, so thank you.
That's great. So yeah, I mean, you've been in this world since like 93, I think, aerospace, defense, government. Last 20 years, you led Houlihan and Loki's, practice in this area. So talk to me about your journey in this, because not many people were in like aerospace and defense, because correct me if I'm wrong, like, we merged down to a bunch of primes, everything came up to the prime, and there hasn't been a lot of transactions back, a decade ago, 2 decades ago. How have you seen that, like, whole transition from kind of centralizing to primes, and now we've got startups everywhere in defense, and it's a hot commodity again? Can you talk me through your observations through that journey?
Yeah, sure. Well, I've been doing this long enough. I feel like an historian of that journey. But I appreciate you recognizing it. When we started in 1993, we started a firm called Quarterdeck, which really was the first boutique aerospace defense focused investment bank. And in 1993, that was, I think, the year of the Last Supper, close to it. There were still a large number of mid-sized aerospace defense companies, but they all began consolidating quickly, maybe as early as 1990, sort of. So what we did for the first several years was largely helping the big primes, when they would acquire their peers, divest pieces that didn't feel like they fit. And at the time, that was mostly component and subsystem suppliers, where they felt they didn't have to own it, they could buy it or partner, etc. And so up until, I'd call it the 2000 election cycle, but it might really have been more driven by 9/11. That was the pace. As you said, the big companies were coming together to form smaller number of primes. But at the same time, the mid-market was actually being bolstered by the capital that was available and the divestitures of great businesses out of those combinations and creating a strong mid-market. By 9/11, post 9/11, those companies were going public. I mean, I think we're in the midst of one of the probably the most active IPO market for defense industrial companies right now. But the last one was 2002, sort of right after 9/11. And then those public companies had more M&A capability. The logic of consolidation in this industry is not just there needs to be smaller number of primes. It's that there's financial engineering to be accomplished at scale with strong mid-market consolidators. And so we've been following that same pattern with more and more and more buyers, private equity, venture capital more recently, mid-market strategics, international consolidation has gradually increased over that time frame. And now we find ourselves in one of the most interesting markets because there's so much more budget growth and so much more capital markets interest. But it has been a continuum.
Yeah, and so from your perspective, the capital, let's say private capital into defense, has been pretty strong, like over the whole journey, or?
It's been growing with a couple step functions. I think it's stronger than ever now. But if you go back to the early 90s when Carlyle Group was forming to do the very first deals, right? They bought Magnavox out of the combination of was it Raytheon and Hughes. Those days, there were relatively few investors. As we got, especially past 9/11, more and more examples of successful financial private capital investment in the sector were there to be witnessed, and more people were attracted to the light. And so we've seen the number of investors interested in this space increase very steadily from at least that 9/11 timeframe until the last couple of years, and then we saw it spike. Obviously, something very different going on than was going on throughout that time frame. They were all attracted. I would say the biggest difference between now and then is most of those companies were attracted by cash flow. They were attracted by strong visibility, long-term programs, relatively predictable competitive risks. Now they're attracted maybe by cash flow, but also by growth, maybe much more by the opportunity for, call it, discontinuous growth.
Yeah, and how do you think that's gonna, this is just fascinating, because most spikes or most surges, collapse at some point. You had the .com, you have, you know, SaaS apocalypse that, people are talking about now, things. So this defense spec, I'd love your perspective on it. But as I look at it, significant capital is going into a broad host of from space, aerospace, defense, technologies. They're not all going to turn into Andurils and Palantirs. And so there's going to be some big misses. But, and how many IPOs will come out of this, who knows? Probably only a handful because, that market seems crazy. But do you think M&A will become the big piece of this as all this private capital has gone into early stage and mid stage growing? Like, how do you see this playing out? Because there is so much capital going into, the space.
I think you have to look at two different categories: the venture capital, or the earlier stage growth capital, and the capital that is still largely chasing the kinds of returns you look for in private equity. If we focus on the first, I do think there is so much of a sea change in how much is coming in, and a real variety of backgrounds of the people that are investing it, from true professionals with very deep teams of seasoned executives or retired government officials, to other investors that are much newer to it. And I do worry that the government contracting universe doesn't understand that venture investment, as it's been applied in other segments, has led to a pattern where 1 in 10, 2 in 10, you tell me the statistic, will ultimately be funded long term by those investors. And that would mean that if you were primarily selecting suppliers out of that universe, you could expect an 80% attrition rate in your supply chain. So there is a reconciliation that has to happen where government has to understand the dynamics of, if it doesn't succeed by this time frame, the venture capital may not keep flowing to that opportunity or that sector. And from the venture investors to understand that this isn't a protein beverage that we can turn into a giant company overnight. It's not the same as a software company. We don't operate on the same timelines in government. And while we're shortening them, there's a lot of effort going into shortening the acquisition cycle, new contracting mechanisms, real focus. We're not going to shorten it to the amount of time it takes to, put out a social media campaign and make a protein drink successful. So that's the venture capital world. The private equity world, I think, is different. Yes, there's more capital in overall private equity looking at defense than there used to be. The institutional barriers to investing in defense, which you've covered on some of your podcasts, ESG, those have changed. If there was a large number of people that saw defense, national security, as a bad guy in their ESG policies, now they're either neutral or maybe, like me, see it as a good guy. And I think, those businesses continue to be valued much closer to the metrics, the same kind of financial engineering, the same kinds of cash flow metrics and valuation metrics that we've seen. They're higher multiples than 10 years ago, for sure. But, they're not vibe investing, right? There's real solid metrics behind those investors, and I think they will continue to do extremely well. It's just, matching the right capital with the right opportunities.
Yeah, and where do you see that private equity capital, that stage of capital Because there are companies that, they raise 200 billion and they're valued, the billion, and they continue to, and I could throw out some company names, but probably less important. When do they want to get involved with that? Because there's a specific company I'm thinking of, but they're still really early in the journey. There's space companies that are, making satellite buses or different things that are, big valuations, raise a ton of capital. When does private equity wait till they become a program of record? Because it's still very, especially in the defense side, that acquisition, there's a lot of risk before it becomes a program of record, the valley of death, or getting when does private equity really look at jumping into? Because I haven't seen, and maybe I'm just not tied into it, a lot of private equity acquisitions of defense companies. Yeah, it's almost like everyone's waiting to see, but I may just have a bad picture on that.
Well, no, I think it really comes down to the definition of private equity, right? So some people use private equity to define all private capital that we invested in equity as opposed to debt. And some people tend to use it as a shortcut for LBO buyers, right? And so what they're looking for is different. And what you're asking about is, to me, the most interesting part of the capital markets right now, which is there's so many flavors, right? So for a founder, a company owner, maybe it's a family-owned company that's been around a long time, maybe it's a brand new founder, for them to find an investor that shares their goals, they need to understand the diversity that's out there and how they align with those interests. Those LBO investors are typically looking for, not universally, but typically looking for 3 to 5 year hold periods. And so they need to know that whatever inflection point they're going to make their return off of is going to happen in something like that time frame, right? Because they're not usually patient enough to wait 15 years. Whereas, venture investors may be looking at a longer timeline, but they're looking for milestones along the way. A program of record is one that I think a lot of venture investors are going to look for in the next few years. They didn't need it before they invested, but if they don't get one on a time frame they're expecting, they're going to have to reevaluate their investment assumptions and whether they keep participating in follow-on rounds or they just sell the company for a strategic outcome at that point. There's just so many. I mean, there's even one of the most interesting classes of investors in defense going way back to before World War I, even certainly World War II, are families, right? If you look at some of the major companies that reindustrialized around World War II, they were individuals or families backing those companies. Some of them still exist today. I mean, Hughes, of course, is one of the most famous names in defense. General Dynamics was effectively a Crown family investment way back then. And families are a class of capital that is much more active in the space right now. Now, they're all different. The Crown family looks to invest multi-generationally. They want to buy companies they're not going to sell. Whereas other families are investing, for their own time frame. I'm going to invest until I retire. I'm going to invest until the time frame for my return is achieved. There's no one answer to what families are looking for, but they're a great investor for national security because they're not on a fixed timeline. Their timelines are usually discretionary, as opposed to, private equity funds make a deal with their LPs that they're going to hold on to the capital for no more than 10 years. And so they're on fixed timelines. And I guess I've gone on a little bit, but to get back to what companies or founders need to think about is, how do I align? What's my timeline? Do I want to work here till I'm 85? Am I looking to retire next year? Do I need more money? Is my team going to stick with me? Do I need to give them liquidity on their options? All these things really play into, in this variety of different kinds of private equity, private capital, which one aligns with the objectives.
And what would your recommendation to founders be that are going through this with defense space? How do they figure, they're busy trying to make their widget. Most of them probably haven't done this before, raising capital, or maybe they just know some. How do they align to figure out all of this, to connect with the right people, to have that perspective?
Well, listen, this is why we started Three Wire, is that we wanted to create a source of advice that is not aligned with just one outcome. Because by definition, many institutions are really only there to be sell-side advisors, or really only there to be private equity investors, or you name it, go down the line. Maybe they've got 2 products or what, but they're incentivized to do one or another thing. So founders need to be careful that they don't just take advice from the first person they meet who's aligned with one outcome, or just look at what their neighbors did who had one set of objectives, but they think hard about their own objectives. And that's what we are. As a merchant bank, when we meet a company, we don't assume they want to do something now. We ask about timelines. We ask, a big question is, do you want to be bought or backed? Which are you looking for? If you don't want to be bought now, when do you want to be? Because if that's not for a very long time, we need to eliminate people who are on shorter timelines. If you want to be backed, does everybody in your team want to be backed, or do you need to provide liquidity to some in a shorter time frame than others? Let's establish how much capital we need for which purposes and for how long. So we start there, and then in some situations, we say, gosh, did you know the Office of Strategic Capital has this loan program that you could accomplish a lot of your capital needs with? Maybe you still need some equity, but we can syndicate that among those high net worth families. In other circumstances, we say, well, your timeline seems very aligned with, we just closed a deal called North Strat, where we were sell-side advisors to Arlington Capital's Gravity platform. And it's a great fit. The timeline of the senior executives who founded that company might be a little shorter, but their willingness to and excitement to roll over and help the company get to the next stage is great. And an unprecedented number of employees rolled their equity into that transaction. Unprecedented in my experience, I shouldn't say. Much larger companies have had employee rolls, but it really was a great fit with the amount of money people wanted to invest or take out on either side now versus wanted to put to work to grow over the long term, and the variety of people involved.
That's great. No, and I appreciate you sharing that, because that's, why we have you on here. Because that is not obvious how to, you know, my experience, again, and I've gone through a little bit of fundraising myself. If you haven't dealt with bankers very often, you don't know how to take them, for someone that it's like, are they trying, is there some deal in here that's not good for me? Because it just hears, there's horror stories. And so having that consultative approach is fantastic.
Well, thank you. I realize I belong to a profession that has not got universal appeal. There's some distrust associated with it, but we're not all distrusted. And I don't think it's a matter of whether the industry's trustworthy. Is understand the incentives and the alignment of the people you're talking to. One of the reasons I'm not at a very large bank is that by definition, most people at those banks have a strong incentive to do one thing or another. Maybe they're on the M&A side, so their incentive is to tell everybody to sell the company. Maybe they're on the IPO side, so their incentive is to tell you that it's a great IPO market. Understand who you're talking to and align your incentives with somebody who can give you real advice.
Yeah, no, I think that's great. And to be honest, the banks that I've met and continue to meet with are fantastic. I don't know. I have this built-in fear of, or I had this built-in fear of, the bank side, and it's been great. I mean, everyone generally, if it's not aligned, it's not aligned. There aren't like predators out there.
Put that word out. We're not predators. That's right.
So you talk a little bit about how how you're talking with companies, but from your experience, when you get into this type of M&A and, world, how much does the geopolitical and kind of policy lens inform your decisions evaluating a company? If it's just like the normal financial analysis.
I mean, it's everything, especially now. By definition, the addressable market for any company in the national security industrial base is going to be shaped by the geopolitical and the domestic political environments, both of them. And forgive me, but the dysfunction in the domestic political environment in getting budgets done on time at all, agreeing on what they'll be sufficiently in advance that companies can make investment decisions, it's a problem. And so to some extent, you have to look beyond the current domestic dysfunction and timelines at the bigger geopolitical environment and be willing to potentially make bets against your product fit with that environment, and that somewhere along the line, our government, other governments are going to become buyers of your product. And I think now more than for many decades, that requirement that investors and company operators make those bets is bigger because the environment is, even as we're looking at unprecedented defense budget increases versus recent years, the manner and the timing at which that is all going to roll out is a lot less clear. Certainly, if you were a contractor to the Department of Homeland Security, was it 5 months of additional shutdown has caused you to question your assumptions about when things are going to happen, and how the cash that may or may not come from sales to that department affect your ability to invest in the future or even keep your workforce in some cases.
It's definitely dynamic. So talk to me then, a little bit more back to Three Wire and just your experience. You know, it doesn't seem there are many companies that you just focus specifically, and you specifically, just AD&G the whole time. Well, what's the advantage of that over just a generalist? I mean, is there really that big of a difference when you look at, opportunities and M&A to be super hyper focused vice more of you're just looking for great opportunities?
Absolutely. I mean, I wouldn't do this job in other sectors because I love, and I think that the people that I work with that run companies really love the support they're providing to the overall national security environment. It is what makes this interesting and motivates me. I've not worked in government. I admire those who do, but my skill set, my ability to contribute to national security is doing what I know how to do, which is this. And so that's what I want to do. I don't want to work on grocery store or shoemaking deals, right? I work in defense, aerospace, and government. And I think that having done it for many decades, and Joe and Charles and others here on my team similarly been focused in this industry most of their careers, whether as engineers at Lockheed like Joe when he started, or as bankers at Moelis where he came from, and then Houlihan where we both came from. We've built an understanding of patterns within the government, and more importantly, perhaps, we've built a network, right? So we know who to ask. I'm not an engineer. I can't tell you whether the tech works, but I can find one that can answer that question. I can find someone who's worked with a customer and can say, well, I knew what they wanted then, and now I can go find you someone who will answer the question. So the depth of our experience, the number of deals we've worked on, 400 or 500 deals in our careers. The number of people you met doing that and the experience you developed are just what you want to have at your side. I don't know if you know the source of the name Three Wire.
Oh, I don't. I live here.
So when a naval aviator lands on a carrier deck, there are 4 wires. I guess on the newest ships, there's 3, but they would typically on a 4-wire aircraft aim for the 3-wire. And our point was, first of all, when you land, you're always prepared to take off. So don't be attached to one outcome. You land knowing that you're going to catch a wire, maybe not the 3-wire, but a wire. But if you sense the conditions are better or not good enough to land, you land with your hand on the throttle and up you go again. So we are taking that same approach to thinking about what's the outcome we're looking for with any given company. And we'll be the first to say the conditions have changed. You do not want to land this plane. You want to take off. There's too much opportunity or there's too much risk. So we're able to do that because that experience that you want somebody landing your aircraft on a carrier to have, we get not just from our own experiences, but from the network that we have.
I love it, but your analogy's wrong. Naval aviators don't land on a carrier. They crash onto a carrier and then take off. Air Force pilots know how to land. To land, you should not spill your coffee.
Fair enough.
Even in a fighter airplane.
Fair enough.
I love that. It's a great way to put it. Is there a difference? You kind of got your strategic primes, the Lockheeds, the Boeings, the Raytheons. When you're working with them on M&A deal, is that a lot different than I'd say kind of this new generation of defense tech? Is there a different way to approach how they operate? Because they're more of the old guard, or is it all starting to merge?
Well, I suspect it will all merge, and I actually think it will be for the best when it does. But right now, for sure, there are very different personalities between, multi-billions and multi-tens of billions of value companies and how they behave, and how a newer company, whether they're venture-backed, founder-backed, or otherwise, those bigger companies have developed I'd say, substantially more risk-adverse cultures for a reason. They were serving a customer who asked them to develop very risk-adverse cultures. And inherently, newer companies, it takes a certain personality to be an entrepreneur. I'm one, you're one. And they behave differently. They can behave differently, and they do. You know, I am a real believer and put my money where my mouth is as an investor that where the old meets the new is the most impactful part of the national security industry and where I want to be invested. Meaning, you have the DNA and experience of someone who's been in this industry for a while, which probably means they worked for these existing companies, maybe the bigger ones, maybe the middle market. And then you've got this energetic, innovative culture of a newer entrepreneurial set of companies. And whether they merge or one primes and one subs or one buys from the other, I think it's where those two come together that both the customer and investors will do the best.
Well, let's just talk about some examples, and if you're uncomfortable, please tell me. But you're like Anduril. So they just closed $5 billion, round, like a $61 billion valuation, double from a year ago. So they've raised like 11 billion, and they're projecting 4 billion in revenue in 26. You've watched this, M&A for 30 years and the fundraising. Is that a realistic number? Can you contextualize that number? Is it rational? Is it a bubble? Or is there something really different, kind of in this environment with a company like that?
I can't contextualize the valuation. I'm not an investor. That I wouldn't take a stab at. But I can contextualize the concept, which is that they looked at the way Washington works and the importance of government affairs, and they created probably the best government affairs department we've ever seen at a time where the Hill and the customer are looking for real new solutions. And now they're going out and finding the solutions. And in some cases, they're building them from absolute scratch by hiring the people with the talent and taking the risk of designing the solutions so far by themselves. And in a lot of other circumstances, they're buying the best solution out there, which is a good example of, how does old meet new? Anduril is the prototype of new. But if you look at a lot of the products that they're being most successful with, and certainly the drone sector would be a good example, solid rocket motors would be another. These are acquisitions. I'll give you another name you might have on your list, Shield AI. I was involved at Houlihan Lokey when Shield AI acquired Martin UAVs, VBAT, which is their primary offering in the unmanned air system sector, was an acquisition. So, those are good examples of how new is taking market share, sometimes by inventing from scratch, but very often by reinventing what's out there to suit the requirement.
And you mentioned unmanned, vehicles and drones. There's just a huge market there. Who's going to absorb all these companies? Is it the primes? Is it new companies we haven't even seen? Because there's just so much. Or are we going to get to an acquisition world where we're living that these smaller companies can actually get program of record and just continue in a smaller capacity for their, capability set that they're delivering?
I think we're living in a new world where programs of record will not be everything. I'm not going to suggest they're going away. They exist for a reason, which is that the life cycle planning, the logistics tails require the government to plan for a long period of time. And that's what a program of record is. But we also are certainly right now looking for capacity and technology at scale right away. And the kinds of steps that have typically been gone through to get a program of record in place may not fit this timeline. So I think you're going to see both out there. You're going to see programs of record inherently compete with something that isn't. And that depends on two things: to create the capital to support the non-program of record. Program of record is, you're borrowing against a series of cash flows, whether you're investing or borrowing against it, that are fairly visible. and you have some recourse if they are changed abruptly. But if you're going to compete against a program of record, you either have to know that there is government funding that is going to support you, even though you don't have a long-term contract, sufficiently for you to size the risk and the capital spend, or you need to find private capital that's willing to take that risk. And let's say we have a lot of drone companies out there. They are definitely not all going to get acquired at production volumes that make their math work. So some of them will fail. Some of them will be acquired by somebody who has the scale to make whatever technical progress they've accomplished that far work. Some of them will go on to either sell at scale without a program of record or shape a requirement and win one. I think it's a pretty crowded space. There are a lot of requirements, but it's a pretty crowded space. So I think we'll see quite a few in the first category of don't make it. And yet we know we're going to be buying autonomous systems of all kinds, class 1 through 5 drones, maritime, ground, all of it. And so there's plenty of room for innovators to find the requirement that the geopolitical, political, and technical competitive environment allow to be the winner.
That's great perspective. And from the drone side, I've had multiple folks come on and talk about this, and I would have to. It seems like this world that we're living in, this new acquisition world, like prototypes are a dime a dozen. They're coming up, but who can actually scale? Seems to be like one of the biggest points as I look across the companies I've talked with and just others in the space. Who has proven capability to scale when you don't necessarily have a scaling contract that does it, but how can you build 10,000 a month?
I think a lot of money is being raised behind companies that have good prototypes and can explain how much money they need to scale. And I suspect that scaling is easier than the step in between that gets a little less discussion, which is you have to prove it works, right? So prototypes are not necessarily battle tested. One of the really interesting lessons from the Gulf Wars is that because we suddenly needed a great deal of equipment that was not in inventory and for which we didn't have programs of record, Joint Urgent Operational Need Statements, JUONs in our acronym-laden world, enabled a lot of prototypes to make it to the battlefield. I worked for a very company back in that time frame called NITEC, which made a ground-penetrating radar. And I remember they were making small numbers of them in Class A office space in Northern Virginia. And they shipped a couple of them over to the Army. And the Army ground-penetrating radar was finding IEDs, so they quickly blew one up. But they didn't blow the other up, and they wouldn't give it back because it was a very valuable piece of equipment. And that led to a rapid production order. That way, the Gulf War served as an incubator, and it showed us that if there's a strong enough demand signal, that private capital will step in and scale itself. But the hard part for industry for a long time that the war gave us a window on how impactful it is they needed an opportunity to be used in battle and prove themselves out. And you can't just let any drone company send their stuff over. Like, people are using this, certainly in Ukraine, they're using it in active war, but even the American military is using it for important purposes. They don't have time to try out everybody's stuff. So those opportunities to get real world tests, sometimes on test ranges, but hopefully more than that, are, I think, going to be the much scarcer skill set than just being able to scale once you get a contract.
Well, that's good perspective. All right, let's keep going on. I think we're going to have to start wrapping this up. So just a couple more questions. These, I may not comment just to get your thoughts on before we do this, but where are you seeing the most interesting deal flow right now, kind of in the AD&G, either by sector, company type?
I'll give you two answers. One, anything that deals with space as a military domain, which, by the way, overlaps very strongly with space's civil exploration domain, and in the sense of protecting our commercial assets and the economy that comes from them, comes to protecting commercial space assets as well. That is just an area of incredible innovation and so much more capital available to it, both government and private, than we've seen in a long time. The other is, I'm going to steal a term from our new CEO at Perry Labs, and where I'm an investor. He calls it the messy middle. And I think this is a really great way to define some of the less sexy businesses that are really, really important to modern warfare. So we all like to look at the airplanes and the robots and the, unmanned ships. And we're, clear on the software, the Palantir analytics that are required to make things work. But in between those is a lot of connectivity, compute, cyber protection, and that messy middle and making it all work in a world where we're moving from highly proprietary systems to open systems, MOSA as an architecture, but that architecture is still not solidly established. I think those are really interesting businesses.
Yeah, it is messy there. For sure. Okay. So 2025, you launched an advisory board, along with that. What does that signal what is your plan for Three Wire? Is it about deal sourcing, credibility, capability? Like, what is your vision with that? And just where do you want to go in 5 years?
Our vision is to be a destination for deal flow at all stages, some things that are going to happen right away, things that are going to happen later, so that we can both as advisors and in some cases as investors or co-investors with the founder or the backers achieve their goals. I mean, I personally want to be involved with the most interesting companies that are going to be successful. By the way, there are some very interesting companies out there that I love to hear about, but that don't have the DNA to be successful. So, we look to meet them, help them understand what we think it would take to be backable or buyable, whichever their objectives are, and play a role in that aligns with the most important people, whether that's the founders or the engineering team that's running it today or, the decision makers about its future. We want to concentrate fire, if you will, in this case, deal flow, and we want to participate in the best companies in whatever way they need us. If they need us to monetize, or if they need us to help them get the capital, get to the next range, or just a little advice to tide them over till the next generation decides what they want to do with the company.
Awesome. What's the single biggest capital inefficiency right now in the defense industrial base? Like, what needs to be closed? Do you see anything that's glaring?
I would say the biggest inefficiency at the moment is that we all talk about the demand signal, but it's not as clear as we'd all like to think, right? There's a lot of discussion about budgets. There's real programs that are in place, but in some cases the money isn't flowing yet. And so the inefficiency is if you bring in a whole lot of capital against a timeline that's this long and it turns out to be this long, you're making false assumptions. So the clearer that demand signal could be in terms of contracts flowing or budgets, I'm asking too much, I realize, but miraculously being accomplished before the fiscal year. I mean, I'd really like to ask for multi-year planning that could be reliable as opposed to just notional headlines. But that's the biggest inefficiency to make this national security industrial base hum.
I agree with you. Sometimes the big big US, the inefficiencies are good. It stops us from going off the rails, but man, it causes a lot of pain. Well, super fun. I appreciate it, Anita. Thank you so much for your time. I have a ton more questions. I'd love when I come out to DC, maybe I'll just go get coffee. I can just keep asking a question. This has been great. But if folks want to follow you or Three Wire, how best do they do that?
3WP.com, the number 3WP.com is our website. We have a LinkedIn as well, and our deals are accelerating, and we announce them all both ways.
Well, this is amazing. Thanks so much, and look forward to seeing you around.
Thanks, Dave. It's nice talking to you.